There's an elephant in the room we need to talk about in a moment there. I need to start with China. I'll get straight to it. Is that credit rating at risk?
A+ stable. It's been there since 2007. So it's one of our longest standing ratings, has not moved. I think the factors that would move it are, you know, if there was some kind of increase, not in government debt, which is around 60%, the way we measure it, but if some of these contingent liabilities in other sectors, the non-financial corporate sector and the banks themselves, become real liabilities for the government. So if it really does extend its balance sheet to support the economy, and I wouldn't say we're expecting that, certainly recent evidence doesn't suggest that would be the case, then we might think again, because the debt to GDP ratio is a little bit on the high side for a single A credit, but we're not really anticipating that kind of policy response from the authorities.
Right, and just to clarify, the 60% ratio that you look at, what would that entail? Because if you add sort of the other complication, that gets you up a couple of hundred. Yeah.
Well, exactly. Yeah. Economy-wide debt is very high. We consider the 60% number to be a reasonable estimate for what we call the general government. So the central government plus lower levels of government, you know, kind of narrowly defined. In China, that's always a little tricky. Where do you draw the line between the public and the private sector? Yeah. So you do see higher numbers, but we work with the 60 number. The bigger numbers, the much bigger numbers, are economy-wide debt.
Okay, and how are you now approaching? Doesn't seem to be still, you know, like some of the shadow findings, for example, local government finance vehicles, corporate debt, debt with the state banks, the cleaning up of some of that debt. They seem to be rejigging who pays that debt and extending the maturities. Do you think we're at a point where it matters from a credit rating perspective, or not just yet?
No, it's mattered for some time. I think the authorities focus on de-risking, if not deleveraging. You know, we were always of the view that deleveraging would be better than de-risking, but we're not really going to see a deleveraging. In other words, the debt to GDP ratio, that larger economy-wide one, probably not going to come down. We think that the de-risking focus is kind of meaningful, and we think there have been some positive developments, not necessarily in the last 3 weeks or 3 months, but over a longer period of time. So that's been helpful, to be fair.
James, the markets, investors are very concerned and watching the property sector in China really closely, yet we saw the government say that, you know what, the woes are just temporary. How are you reading that, and what are the risks of such an approach by China?
Look, you know, the property sector is the biggest sector of the economy in the second biggest economy. So for some time, we've considered it to be the most important single sector of the global economy. So we don't think that what's happening in the property sector is something that's temporary or cyclical. We think there's a structural change underway. It is not going to be the growth driver of the Chinese economy the way it has been in the past. This is what the authorities had intended, so this is not an unintended consequence. Maybe some of the spillovers to the broader economy and confidence are unintended, but I think shrinking the importance in terms of the contribution to growth of the property sector has been the intention all along. So we're not, that's one of the reasons why we're not necessarily expecting the government to sort of step in and provide massive support to property developers at all. There's a structural change that's going on, and that was an intended structural change to some degree.